Two of the most prominent consumer-facing companies in the world, Amazon and Starbucks, reported their earnings this week. Their earnings reports are watched not just because of their own financial health, but also as barometers for the state of the economy. In the past, slowdowns in Amazon's e-commerce sales growth and AWS cloud division have often given warnings for weaker business and consumer spending. They generally foreshadow economic contractions to come. Similarly, Starbucks sales tend to reflect the financial well-being of middle and upper income consumers. When discretionary spending tightens, Starbucks often sees fewer customers buying its premium priced beverages. Again, case in point, in the depths of the 2008 financial crisis, Starbucks same-store sales in the US declined by mid-single digits for several quarters, indicating consumers were cutting back. In this video, let's look at what signals about the economy Amazon and Starbucks are sending after their latest earnings. Let's begin. Let's start by looking at Amazon's Q1 2024 earnings. Firstly, you'll see that their revenue increased by 13% to $143 billion, beating analyst expectations. The North American sales grew 11% to $82.8 billion, while international sales rose 15% to $41.1 billion. Their net profit came at $10.4 billion with a 7% margin, while their gross profit came at $70 billion with a 49% margin. If you look at their individual segments, their e-commerce business grew 7% year over year at around $55 billion. Looking at the AWS business, it grew 17%, coming in at $25 billion. One of the very impressive numbers is their advertising revenue. It increased 24% year over year. It sits at around $12 billion. And you'll see there's growth across other consumer segments as well, such as Audible, Prime, and Twitch. Amazon also announced plans to invest over $1 billion in Gen AI technologies over the next few years. So what is Amazon's Q1 performance telling us about consumer spending? The strong growth in Amazon's North American and international markets tell us that the consumer is quite resilient so far. The 11% increase in North American revenue indicates that US shoppers are still spending robustly online even as inflation remains elevated and concerns about a potential recession linger. Meanwhile, the 15% jump in international sales points to improving consumer confidence abroad, particularly in Europe and Asia. Amazon's ability to gain market share in key international markets like the UK, Germany, and Japan bodes well for the health of the global consumer as well. However, it's worth noting that Amazon's first-party sales, where it sells products directly to consumers, only rose 5% compared to the 18% growth for their third-party seller services. This could suggest that while consumers are spending, they may be moving on to cheaper and more generic options on Amazon. Overall, the consumer spending does seem to be quite resilient. If we look purely at just this metric, we would assume that the economy is doing just fine. Now, let's turn to Amazon's cloud business AWS to see what it tells us about business spending. AWS's impressive 23% revenue growth and near doubling of operating income indicate that businesses are still investing heavily in cloud infrastructure and digital transformation, even in an uncertain economic environment. Many companies are likely adopting their suite of cloud services to help them cut costs, streamline operations, and gain insights from data analytics. The strong demand for AWS also reflects the accelerating adoption of AI and machine learning technologies across industries. Amazon's announcement that it plans to invest over $1 billion in generative AI suggests it sees massive potential for growth in this area as more businesses look to leverage AI to drive innovation and efficiency. Additionally, AWS is facing intensifying competition from rivals like Microsoft Azure and Google Cloud, which could pressure its margin going forward. For Q2 2024, Amazon expects net sales to grow between 10 and 16% year over year to $132 to $140 billion. While this guidance is solid, it does represent a slowdown from Q1's growth rate. As seen here, you can make the argument that that might be the reason why the stock did not move a lot after really good earnings. Amazon also noted that foreign exchange headwinds from a stronger US dollar could negatively impact sales by approximately 200 basis points in Q2. Looking ahead, Amazon delivered a cautiously optimistic tone for the rest of 2024. The company believes that investments in AI, logistics, and international expansion will continue to drive growth, but acknowledged that macro uncertainties around inflation, interest rates, and geopolitical tensions could weigh on consumer and business spending. A key risk to watch is the strengthening US dollar. It makes Amazon's products and services way more expensive for international consumers. If the dollar continues to appreciate against major currencies like the euro, yen, and pound, it could be a significant drag on Amazon's overseas sales and profits. But yes, the growth proves that a lot of businesses are not really cutting down on spending right now. We'll look at what it all means for investors later in the video, but first let's look at Starbucks Q2 2024 earnings. Starbucks reported weaker than expected quarterly earnings and revenue. Their revenues are down, their net earnings are down, and their EPS came in lower than expected. If you look at the revenues from different segments, their North American markets remained flat, while the percent change on the international side was negative 5%. Their same store sales unexpectedly declined by 4%, with traffic falling up to 6%. As stated earlier, their revenue fell short, came in at $8.6 billion, while the street was anticipating $9.13 billion. And finally, you'll see that their operating income is down 17%. Overall, the performance of Starbucks this quarter was quite bad, but what does it tell us about consumer spending? The surprise decline in sales and traffic suggests that the consumers are becoming more and more cautious about discretionary spending. As you might all know, Starbucks coffee is not the cheapest one out there. Honestly, I'm quite happy about their traffic's going down because I would rather have people not drink that coffee. The coffee doesn't taste good or it's extremely sugary. But from the eyes of an investor, the weakening consumer demand is quite concerning. The CEO of Starbucks attributed the decline in sales to consumers being more selective about their spending too. This trend is in line with recent earnings reports and forecasts from companies like DoorDash, CVS, Etsy, and Netflix. They also suggest that consumers are being squeezed by the persistent inflation and are cutting back on non-essential purchases. It's a well-known fact that when things get difficult, consumers tend to cut down on discretionary spending like buying coffee from Starbucks. However, I would say that it's worth examining some of the specific challenges that Starbucks is facing. Firstly, there's no denying that Starbucks coffee is expensive compared to many other competitors. With prices for a basic latte or cappuccino often exceeding $6, it's easy to see why consumers might choose to brew their own coffee at home or visit lower priced rivals such as Dunkin' or McDonald's. This actually ties in well into the idea of a caffeine bubble that has formed in the market. I first heard this term from YouTuber Joseph Carlson. The caffeine bubble refers to the oversaturated market of coffee shops and packaged coffee products. This makes it even harder for Starbucks to stand out with its premium prices. Secondly, it's no denying that Starbucks is facing intense competition in the coffee business. Now it also has to worry about newer entrants like the recently launched McDonald's Cosmics. Again, it ties in with the caffeine bubble and it seems like everybody wants a slice. Finally, we should also acknowledge the potential impacts of the ongoing boycott attempts of Starbucks by some consumers. This is due to the company's stance on the Middle Eastern conflict. I personally don't see this having a huge impact on the numbers that we are seeing today, and it's more of a reflection of the broader economy. It doesn't matter if all these reasons apply or not. What Starbucks is telling is that there's a weakened consumer demand. You might have also noticed that the Starbucks stock is suffering quite a bit after their earnings. So what is really going on? The contrasting reports from Amazon and Starbucks paint a very complex economic landscape right now. While Amazon delivered impressive results surpassing expectations on both revenue and earnings, Starbucks struggled with weaker than expected sales and declining customer traffic. The key to understanding this could also lie in the nature of both the businesses. Amazon has successfully diversified its operations across multiple sectors, creating a robust ecosystem that encompasses e-commerce, cloud computing, streaming services, and smart devices. This diversification strategy has allowed Amazon to tap into various revenue streams and capitalize on synergies between its businesses. Amazon also has a very strong and loyal customer base, more so than Starbucks. Even with its loyal base, Starbucks primarily operates in the coffee business. This makes it more susceptible to consumer spending and increased competition. The earnings just exposes the fact that the company is highly reliant on discretionary spending by consumers. Okay, it's time to bring an investor perspective to all of this. For investors, the mixed signals from Amazon and Starbucks warrant a cautiously optimistic approach. However, I do believe that there are several reasons to stay bullish for the rest of 2024. Reason 1 is continued recovery. Even though the pandemic was over 2 years ago, the global economy continues to recover from it. This recovery will continue to benefit a wide range of industries from e-commerce and technology to consumer discretionary sectors. Reason 2 is technology. The rapid pace of technological advancements, particularly in the fields of AI, machine learning, and cloud computing, is expected to drive significant growth opportunities across various sectors. Again, companies like Amazon are at the forefront of this. Reason 3 is monetary policy. The Federal Reserve and other central banks worldwide are expected to cut rates later this year. The hope is that inflationary pressures would have reduced significantly by then. There is still hope that we'll see lower interest rates. Lower interest rates also tend to drive significant capital towards the stock market. The 3 reasons we just discussed are more current and known reasons. Let's look at 2 more that you may not be aware of. The fourth reason is simply because it's a US presidential election year. Historically, US presidential election years have been generally bullish for the stock market. The political cycle often brings increased fiscal stimulus, tax reforms, and other policies aimed at boosting economic growth. Usually in the middle of the election year, you do see a downturn. In a recent video, I did mention that I was expecting a pullback of about 6 to 12% in the upcoming months. Since that video, we have already seen over a 6% pullback. Even though times are getting scary, it's well within bounds of what we were expecting. The fifth reason is actually the real estate cycle. The real estate market operates on an approximately 18.6-year cycle with periods of growth followed by periods of contraction. Understanding the current stage of the real estate cycle can provide valuable insights for investors. I would suggest you spend some time understanding the current stage of the real estate cycle. If the cycle continues, we'll see a booming real estate market. It'll also drive up stocks and other assets with it. I've also covered these topics in this video. Feel free to check it out. While these factors paint a very promising pictures for investors in 2024, it's also important to stay vigilant and watch out for potential risks. Geopolitical tensions, inflationary pressures, and the evolving regulatory landscape could impact the performance of individual companies and the broader market. We should also keep a close eye on the Federal Reserve's actions and any shifts in monetary policy that may affect market sentiment. While I remain bullish for the remainder of 2024, we have to recognize the fact that we are no longer in the 2021 kind of market. In 2021, the uptrend in the stock market was characterized by a very broad-based rally. In general, what it means is that during that time, you could pick any stock and it would go up over the next few days. Everybody was a genius in 2021, but we all saw the brutal pullback in 2022. Anyway, as you navigate this market for the rest of 2024, you have to be very selective in your investment choices. In this market, we have to emphasize and spend a lot of time selecting good quality businesses. We should look at strong fundamentals, resilient business models, and clear growth prospects. These companies should have also demonstrated the ability to adapt to changing market conditions, innovate, and maintain a competitive edge. One of the prime examples of such a business is the company we saw in this video, that is Amazon. Amazon is a great company with a lot of growth potential ahead of it. It has a well-diversified business model with a strong foothold in e-commerce as well as cloud computing. I would go as far to say that Amazon is likely to surpass Apple and Google in its rankings. Well, on the other hand, I'm staying very far away from companies like Starbucks. The current numbers and the forecast doesn't look good for Starbucks right now. While it might be a good buying opportunity right now, I would rather wait a few more quarters to see how everything develops. Generally, find good companies and invest in them and try to stay away from enormous amount of risk. In my videos, I regularly disclose the other companies and assets I hold, so make sure you subscribe. That's all for today's video, and as you choose your investments, remember to keep learning and stay on top of your finances. Until next time.